Efficient market security provides return of 12.5% with risk of 21%. If acceptable risk is 25%, find how much return can be expected. Risk-free rate 12%, we have to calculate. Efficient market security. What is capital market line? Let me remind you quickly. On x-axis, we will have the standard deviation of portfolio. Y-axis, we will have risk return or portfolio return basically. So this is basically standard deviation and this is basically return, y-axis. And you draw a line. What is that? Starting point. The starting point is risk-free rate. And at market risk, how do we represent market risk? Market risk is sigma m. At market risk, you will get market return, that is Rm. But if you take risk more than market, you get return more than market. If you get risk less than market, you get return less than market. And if you don't take any risk, means still you should get return, that is risk-free security return. That's what capital market line told. And take a look at this problem. We can calculate this in two ways. Both ways you get the same answer. Let us calculate. Efficient market security provides 12.5% with risk of 21%. Efficient market security means market. What is the market return? 12.5%. Market return, we say market. We also say efficient market hypothesis. Market is efficient. You cannot go beyond that. The price will reflect all the factors. Anyway, market return, efficient market return. With risk of 21%, risk means sigma m. Market risk is standard deviation of the market, sigma m. And acceptable risk is 25%. So your portfolio is 25% risk. Now you please tell me, how much are you investing in the market, or are you taking risk more than the market or less than the market or equal to market or no risk at all? If you remember, we discussed 4 portfolio, right? One comes here, less than market risk. One comes here, equal to market risk. One comes here, more than market risk. How can you take more risk than market? By leveraging your position. And risk-free rate means you don't take any risk. So what is your risk here? You are taking 25% risk. Acceptable level of risk is 25%, but market risk is 21%. So you are taking more risk than market or less risk than market? 25, more than 21. So it is more risk than market, right? So when you take more risk than market, you should get more return than market. Another way of understanding or other way of calculation, target risk or acceptable level of risk, portfolio risk. That is sigma p is 25%. Market risk is sigma m, which is 12%, sorry, 21%. So the portfolio risk is more than market risk. Portfolio risk is greater than market risk. Therefore, how much is your weights in market portfolio investment or weights in market portfolio? That is weight in market portfolio. I'll say WM. Weights in market portfolio is sigma p by sigma m. It is proportional. The amount of investment you are making in two securities, one is market portfolio security, another is risk-free security. And how much you invest is proportional to the risk taken. That's what capital market line says. The proportional to the risk taken. So how much risk you are taking? It is 25% for 21%. So 21% is market risk, but you are taking 25%. Your risk is greater, so your investment should be higher, proportionate. So 25 by 21. Okay, let's keep it as 25 by 21. The weight is 25 by 21. More than 100%. Right? And what do you mean by that? How can you invest more than what you have? How do you create that what you don't have? You are going to borrow. So weight in risk-free security is 1 minus weight in market security, 1 minus 25 by 21. So you cross multiply 21 minus 25. So you get minus 4 by 21. Essentially, you are borrowing. Back to the graph. What did we discuss in capital market line? You take a less than risk of market, equal to risk of market, more than risk of market. So we are in that last category, more than risk of market. And how do you create such situation? More risk than market. That is by leveraging position. That is by borrowing. So you invest more amount in market portfolio, where in risk-free portfolio you don't invest, you borrow. You borrow and you invest. Okay, so what is going to be portfolio return? Portfolio return will be a weighted average, right? So portfolio return RP is a weighted average. So return in risk-free security into weight in risk-free security plus return of market into weight of market portfolio. Risk-free is 12%. Its weight we just calculated minus 4 by 21 plus market return. Efficient provides 12.5% return, and the weight of market is 25 by 21. So 12 into 4 by 21 minus 2.2857, let's say minus 2.29. 12.5 into 25 by 21. 12.5 into 25 by 21. 14.89. 88, I think. Okay. 14.88 minus 2.29. 12.59. 12.59. This is using weighted average concept. We are calculating capital market line. And let me also tell you, a capital market line from exam point of view is theory only more important. In exam, questions are revolved around mostly beta, characteristic line, and capital asset pricing model, CAPM, security market line. They're the focused areas from exam point of view, even practical life point of view. But as a theory, we had learned capital market line. So for the problem, I'm doing this just to reassess, revise, reassure ourselves about capital market line, the calculations. Okay. So this is one way of calculating. There was one more formula, if you remember, or main formula actually for capital market line, where directly we equated. Remember the formula? Directly we equated return of a portfolio for a given level of risk, that is RF plus RM minus RF into standard deviation of market, standard deviation of portfolio divided by standard deviation of market. Do you remember? This we had discussed. In fact, this looks like CAPM, but see in CAPM, this is beta V multiply, not the standard deviation. Anyway, that we'll handle later. So risk-free return in this case, risk-free security is 12%. RM minus RF, market return 12.5 minus 12 into sigma P. That is, what is the sigma P? Standard deviation of portfolio, acceptable level of risk 25 by sigma M 21. So which is 12 plus, this is 0.5 into 25 by 21, 0.59. So 12 plus 0.59, we got 12.59. You can see we have got the same number, 12.59. Okay. I would like to give one more explanation for this. Hope you have taken down. Again, this is just explanation part. This is not really from exam point of view. It's only for understanding from a concept point of view, not from exam point of view. If I take you back to a little bit of your history, that is your IPCC, previous life, past life, we had one measure called as ROE, and we had one measure called as ROCE, return on equity and return on capital employed. ROE, return on equity, is from equity shareholders point of view, whereas ROCE is from business point of view. Basically, ROE is a profit after tax based calculation. ROCE was operating profit calculation. And how it was different, let me show you by simple example. Suppose company is there, they take money from equity and they take money from debt. Let's say they have taken 100 rupee from equity, 100 rupee from debt. Let's say they are maintaining debt equity ratio of 1:1. So totally how much they have now with them? 200 rupees. And they will invest in business 200 rupees. This is their investment. Now let's say the business gave you return of 20%. The 20% is called as ROCE. From the business, how much you generate, irrespective of capital structure, is called as return on capital employed. From your business, you employed 200 rupees and you generate 20%. 20% on 200 means you will get 40 rupees. Now, on debt, what you have to pay? For the debt, you have to pay interest. Let's say interest is 40, you have to pay rate of interest of, let's say, 8%, or let's say 12% interest you have to pay, 12% on 100 rupees. So you will be paying them 12 rupees. Now, if 40 rupees is what you generated, 12 rupees what you paid to debt, how much remains? What remains is 40 minus 12, that becomes 28. So what is the return that equity shareholders have got? 28 rupees for 100 rupee invested. So they have got 28%. Take a look at this. What business has generated? 20% return. But how much equity shareholders able to generate? 28% return. Where that extra 8% coming from? Can you imagine where that extra 8% coming from? Or why is that extra 8% coming? What is the impact? What do you think? The extra 8% is coming from debt element. What is that debt element? You have taken loan from them 100 rupees. From 100 rupees, you invested in the business, you generated 20% return. But while giving them, you did not pay them 20%. You paid them only 12 rupees in rate of interest. You pay them fixed amount. The surplus 8 rupee was there, right? The surplus of 20 minus 12, 8 rupee. That 8 rupee got added to your pocket. Are you able to understand where that excess is coming from? Or formula wise, we used to tell like this. ROE, return on equity, is given by ROCE. This will belong to you, and one extra surplus will come to your pocket. That is what you generated, ROCE, minus what you paid them, interest. This surplus also will come to you. Of course, this will be proportional to the amount of loan taken, debt by equity. In this example, ROCE was 20% plus ROCE was 20 minus rate of interest you took, you paid only 12. So debt by equity 100, equity ratio, equal ratio. So 1 by 1. So it is 20 plus 8. That's how you got 28%. But also remember this ROC minus interest. If ROC was less, interest was more. The surplus will become shortage. In that case, it will be taken away from the ROE, where you will have lesser return than what is given by business. So debt can be positive as well as debt can be negative. And when is debt is beneficial? As long as you're able to generate surplus here, ROC more than interest, debt will act like a positive impact on your business. But if ROC is lesser than interest, then the debt will be riskier and it started taking away your share of profit as well. That's what we say, risk aligned with risk available with debt. Okay, this discussion is not the final discussion. This discussion we had in the intermediate itself. This is just a recap. If I apply this concept for the problem we have, we get the same answer. How? Please observe. In this example, in this problem, what we had, what is the rate of return? What business is providing, how much return market is providing. If I use this formula, exact same logic. How do you calculate ROE? What ROCE? How much the market is giving? Market is giving return of market portfolio giving a return of 12.5%. Yes, this is going to be your return. Plus some surplus will come. What surplus will come? Difference between the ROCE and rate of interest. What is ROCE? That is 12.5 minus how much interest rate, risk-free rate you are borrowing. So how much is the interest rate, risk-free rate? 12%. So 0.5 is the extra, but you should proportional to debt and equity. How much amount of debt you have taken? Proportionately, the weight was 25 by 21, means 21 rupees you take it from your pocket and 4 rupees you borrow, and totally you invest 25. That's what it means, right? 25 by 21, 4 by 21, which means 4 rupees comes from a loan and 21 rupees comes from your own pocket. So into debt by equity, so I will do into 4 by 21. You check out whether we get the same answer. So 12.5 minus 12 into 4 by 21, you get 0.09, and that's what, right? 12.59. We had got it earlier, percentage. Anyway, these are all the factors that you should understand about impact of debt, about impact of taking leverage position, and what do you mean by capital market line, and how can you take more risk than market. So these are more about interpretation than just the numbers. So you can take down. If you have any doubts, let me know. Okay, hope it is done. I'll go further. Okay, come to the next problem. Next problem. This problem is came in RTP November 2010, but this is a very rare problem. Technically, it is there, but in our syllabus, we don't read these things in detail. But we never know. Some time exceptional situation, institute can pick up this question and ask in exam. One sudden bomb may be there, surprise. So we will do this question. But this is not a repetitive question, one time question. And formula is also unique formula here. So what formula we discuss is only limited to this problem. So this, take it as a exceptional problem. And formula also will be specific to this situation, will not be applicable to others, and this is not a repetitive problem. And in fact, at least in last many years, I have never seen this question. Let's read. Suppose that in the universe of available risky securities contains large number of shares of two stocks identically distributed with return of 15%, standard deviation of 60%, and common correlation coefficient with 0.5. What is expected return and standard deviation of an equally weighted risky portfolio of 25 stocks? 25 stocks. We learned the formula for 2 stocks, 3 stocks, for 25 stocks. If it is equal weighted, there is one formula which we are going to discuss. But that is with respect to this problem. Okay. If it is 26 stocks, 27 stocks, equal weights, okay. But different weights, we don't have a particular formula. So it's more of a theory question rather than practical application. What is the smallest number of stocks that is necessary to generate efficient portfolio standard deviation equal to or smaller than 43%? What is systematic risk of the security universe if T bills, treasury bills are available and yield 10%, being risk-free rate? What is the slope of capital allocation line? Okay. What is the expected return of standard deviation of equally weighted risky portfolio? Expected return. Okay. Expected return, return and risk of 25 stocks. Portfolio with 25 stocks. Okay. First of all, expected return or a portfolio return, I'll say. Portfolio return, which is expected return, will be equal to 15% only because equal weights, right? Equally weighted. So if you invest equal amount, average also will be same number. Everything is going to give same return. So 15% itself, equally weighted. But standard deviation of portfolio is not equally weighted. There is a formula for it. For 25 stocks, 2 stocks A plus B whole square formula. For 25 stocks with equal weights. Okay, this is with equal weights. If it is not equal weights, this formula does not work. Equal weights. It is given by standard deviation square by variance, the by number n plus standard deviation square into n minus 1 divided by n. I repeat, this formula is unique with respect to this problem. This is not a repetitive problem. Make that point yourself very, very clear. So, standard deviation square. What was standard deviation? 60. Yeah, standard deviation 60%. So, 60 square by 25 stocks plus 60 square into n minus 1. So, 25 minus 1 by 25. Then square root. 60 square, 60 into 60 by 25, 144 plus 60 into 60 into 24 by 25, 3456. Add 144 and take square root. 60 is it? Sorry, into 0.5 is also there. This you should do into R. Correlation also you should consider into R. Into R. Into R. Into 0.5. Correlation coefficient 0.5 I think. So 3456 into 0.5. Square root 43.27. The basically standard deviation of portfolio that A square, B square, C square, that formula only, but equal weights. Everything is 0.5, 0.5, and R is also same correlation between all the securities. All correlation are same. That then they simplified this formula. This is a mathematically simplified formula, so it's not a usual regular applied formula. This is first part of the question. Second part, what is the smallest number of stock necessary to generate efficient portfolio with a standard deviation equal to 43%? Okay, now here we got the standard deviation as 43.27 for 25 stocks. Now, if I want this to be 43%, what should be n? Find number of stock to generate standard deviation of 43%. So you use the equation, you have to find n such a way that it comes, the value of n should be what? We have to simplify this equation. So what is the equation? Standardization of portfolio, this should be 43%. What should be n? Find out. Thus this should be 43 sigma m square. That is what we have to, that is what is given. That is 60 square. That's already calculated. Divided by 25, you don't do it. I need to calculate that n. Plus n sigma square, 60 square into n minus 1 into r, which is 0.5 divided by n. Square root. And how do we take the square root? In mathematics, square both sides. So 43 square equals 3600 divided by n plus 3600 into 0.5. 1800 into n minus 1 divided by n. So 43 square 1849 equals n, I can take it common. So 3600 plus this, I can open the bracket, 1800 into n, 1800 n minus 1800 into 1800. N I can cross multiply. So I get 1849 n, 3600 minus 1800, that is 1800 plus 1800 n. This I'll take it left side. 1849 n minus 1800 n is 1800. So 49 n is 1800. So n equals 1800 divided by 49. 36.73. 37 number of stocks. So if I have at least 37 stocks, then I will be able to reach a portfolio risk of 43%. Okay. Next, third part of the question. What is systematic risk in the security universe? To be specific, what is systematic risk and how do we calculate from a two security portfolio? Those things we'll calculate later. But as of now, just remember, systematic risk means the portfolio connected with market or market risk, you can say. Portfolio or the security connected with market. Now, what is the standard deviation? 60%. And what is the connection with the market and how the securities are connected with the help of coefficient. So you simply do standard deviation into R or standard deviation square into R square. That's what you are going to get as market variance or the systematic risk of the security. This comes again for this problem. There are very important formulas for systematic risk and application problem also. We'll see it later. But as of now, you can take it systematic risk of universe is given by whatever is the standard deviation of the securities they have given multiplied by the correlation coefficient. So this is 60 square into 0.5. That is I think 1800, and you can take square root of it. Standard deviation of P, square root of 1800, 42.43. 42.43. Okay. Last part of the question. If the risk-free rate is 10%, that is got 3 bill means risk-free rate. What is the slope of CAL? What is CAL slope? The formula you remember, the RF, the risk-free rate, similar to CML only. CAL, CML both are equal when you invest in market portfolio, and we are having universe market portfolio only. So RF plus RM minus RF multiplied by standard deviation of portfolio by standard deviation of market, right? This is what is called as slope, the proportional number, that constant, that multiplier. That's what is called as slope. That's what we need to calculate here. The slope of CAL, that is given by standard deviation of portfolio by standard deviation of market. Now standard deviation of portfolio, just now we calculated, we can make use of that only. Okay, no, risk-free security, sorry. That proportional number we are going to apply here. Risk-free security. So how much return we are getting over the premium amount? Just 1 second. So the slope of security, that second part, RF plus the second part what we get. So I will write RM minus RF over and above what I get risk-free rate, then divided by whatever standard deviation of portfolio or standard deviation of market. Then you multiply it by standard deviation of portfolio. Now this portion, as you take more risk, your return will change. We just want only this much. Okay, I'll tell you once more so that you understand. RF plus RM minus RF divided by standard deviation of portfolio into standard deviation of market into standard deviation of portfolio. So if you take different risk, you get different return, but this much will remain constant always. So this portion is called as slope. Sorry, I think I told you sigma p by sigma m as slope. Small correction. Rm minus Rf by sigma m. That portion is called as slope. Therefore, slope equals Rm minus Rf divided by market variance, market standard deviation. Market return 15 in this problem because everybody is equal weights. Risk free is 10, treasury bills. By market risk, we just calculated now. That is, this is systematic risk, market risk, systematic risk of the universe. Systematic risk means risk connected with market. That's what I'm taking. 42.43. That is 5 by 42.43, 0.1178. Anyway, so as I told you, this is a very unique problem, not a repetitive problem. So take this as one of kind, and please don't take this problem or formula for any other set of problems. It's a unique formula with respect to this particular problem. Portfolio management is a large area, my dear friends. It's a study, it's a subject by itself. So lot of things are there. We are just trying to understand what is relevant within our portions. Some, our RTP previous year question paper will have some exception questions, so we prepared for that. We can't read entire portfolio management, that itself will become separate course. So we have to manage our risk as well. Anyway, so hope you are able to do this problem. Okay, so let's go further. Good. Hope you got this question. This type of problem are definitely frequent from exam point of view. So many times they have asked. Return of stock A and market portfolio for a period of 6 years are as follows. Year 1, 2, 3, 4, 5, 6. Return on A, return on market portfolio. You are required to determine characteristic line for stock A, systematic and unsystematic risk of stock A. Definitely they've asked so many times this type of problem, definitely important from exam point of view. Okay, so we have given two lines, two data, two stock, one stock and one market. We have to do characteristic line, and characteristic line nothing but regression line. One variable is dependent on another variable, y equal to something x. And here I will not say y and x, you can use x will be usually market independent, security will be dependent usually. So characteristic line for stock A, we are going to solve by regression line method. What is regression line? Not sure if you remember the formulas. What is the formula? Regression line, return of security is dependent on market return, and that's going to be alpha or A plus beta into return of market. Previous all theories talked about risk and return, but this theory, this line will talk about return and return, market return and security return. And how do you calculate beta? Beta is calculated by R into standard deviation of standard deviation of S by standard deviation of market, or you can calculate in various ways. Or formula is there, covariance formula is there. We can also do by covariance by market variance, and direct formula is also there. That is n into summation sm minus summation s summation m divided by n into summation m square minus summation m whole square. This formula is also there. Quite a few formulas for b, beta, and this alpha or a is calculated by simplifying this itself, rs minus beta into rm. Yes, I'll put bars. This is what is the formula is all about. But either case, what are the columns we require? One column for security return, one column for market return. I need the standard deviation of security. So I'm going to do s minus s bar whole square, and I'm going to do m minus m bar whole square, because I need market standard deviation. And one more column I require. Can you think what could be that? We are done in the basics also. S one column, M one column, S minus S bar square, M minus M bar square. Then one more last column required, that is for covariance. S minus S bar into M minus M bar. So these are the things which we have to do. Let's do it. S and M, security return, market return. You please repeat those two columns. Uh, those two columns you repeat it and do the total. You can do the column S and M, or you can also do the column X and Y. But market, you always take it as X. X is always independent. Huh? So market, you always take it as independent X. Okay, then we need S minus S bar. So I need S bar, which is 38 divided by 1, 2, 3, 6, 6 here. 38 by 6 and 34.5 by 6. You get 6.33 and 5.75. Okay. Now, what next we require? S minus S bar. Then S minus S bar whole square. So 12 minus 6.33. 5.67. 15 minus 6.33. 8.67. 11 minus 6.33. 4.67. 2 minus 6.33. Minus 4.33. 10 minus 6.33. 3.67. Minus 12 minus 6.33 minus 18.33. Total you can verify. It should be 0. You can do a cross verification. S minus S bar over M minus M bar will do. Then I'll do M minus M bar whole square. S minus M bar whole square I'll do it. M minus M bar. 8 minus 5.75. 2.25. 12 minus 5.75. 6.25. 11 minus 5.75. 5.25. Minus 4 minus 5.25 minus 9.75. 9.5 minus 5.75. 3.75 minus 2 minus 5.75 minus 7.75, and cross verification you can do. Total will be 0. Then S minus S bar whole square, 5.67 into 5.67, 5.67 square, 32.15. 8.67 into 8.67, or you can do into equals in the calculator. 8.67 into equals. 4.67 into 4.67. 4.33 into equals. 3.67 into equals. 18.33 into equals. You'll get the number and you can do the total summation S minus S bar whole square. This is summation S minus S bar whole square. M minus M bar whole square, 2.25 square, 5.0625, round off 5.06. 6.25 square, 39.06. 5.25 square, 27.56. 9.75 square, 95.06. 3.75 square, 14.06. 7.75 square, 60.06. Total 240.86. Summation M minus M bar whole square. For covariance, I need S minus S bar into M minus M bar. So use that 5.67 into 2.25. I think you get 12.76. 8.67 into 6.25, 54.19, 4.67 into 5.25, 24.52, 4.33 into 9.75, 42.22, 3.67 into 3.75, 13.76, 18.33 into 7.75, 142.06, and total 289.51. Please prepare this table. I hope even in basics also we discussed, so this should not be difficult for you to calculate. These are all mechanical stuff, but you have to learn. Okay. Next, what and all we require for regression line? I need standard deviation of security, standard deviation of market, and covariance. And using these three, I'll compute correlation. So, standard deviation of x summation s minus s bar whole square, that is 497.33, divided by number of years, 6 years, 9.104. Standard deviation of market summation m minus m bar whole square, which is 240.86, divided by 6 number of years, you get 6.34. Then covariance summation m minus m bar into s minus s bar, the product of deviation, divided by n, that is 6, you get 48.25. And therefore then R, correlation coefficient, what we calculated now, covariance 48.25, standard deviation of security by standard deviation of market, standard deviation of security into standard deviation of market, 9.104 into 6.34, correlation coefficient approximately 0.8359. Okay, we need regression line. Security is alpha plus b into market return, rs, or I've just written s, and beta is calculated by r into standardization of security by standardization of market, security risk by market risk, 0.8359, that is correlation coefficient, standardization of security 9.104, and market standardization 6.34. 1.2. A value, this is rearrangement of this itself, security return, that is S bar minus beta into M bar. S bar, we have it here 6.33 and beta we calculated 1.2 and M bar that is 5.75. So we get minus 0.57 plus 1.2 M, that is A plus BM. A is minus 0.57, B beta 1.2. So security return depending on market return is minus 0.57 plus 1.2 M. Okay, so this regression line is nothing but characteristic line. Regression line we call in statistics. Characteristic line we are calling it in portfolio management. And one more thing I'll tell you, if the question was only about regression line, only about characteristic line, I can save lot of these things. What I require is beta. And what is the formula for beta? One I told you, R into sigma S by sigma M. We can also do by one more formula, covariance by market variance. What is covariance? Covariance is summation x minus x bar or s minus s bar into m minus m bar divided by n. Okay, let me write it here. So what is covariance? Summation s minus s bar into m minus m bar divided by n. That is covariance. And what is market variance? Summation s minus s bar, m minus m bar whole square divided by n. Square root is standard deviation. If I take the square root out, that is only variance. And if I cancel n and n, what remains? Summation s minus s bar into m minus m bar, which is this 289.51. And divided by summation m minus m bar whole square, m minus m bar whole square 240.86. So 289.51 by 240.86. 1.2 only you get directly, isn't it? Means this s minus s bar whole square column only not required. I'm not using it. I'm using only market variance. This standard deviation, without standard deviation also, this standard deviation I'm not using. This standard deviation I'm not using. This covariance I'm not using. This R I'm not using. Are you understanding? This entire part I can skip. I can use the beta. I can calculate the beta just by this table only. This entire calculation I can skip. Sir, why you did not do it? Already you are wasting our enough time, precious time, and you are wasting our time again. Why did you explain so much where you got the answer in just the column total 289.51 divided by 240.86? You there only you got the answer. Yes, I agree. If they ask you only characteristic line, this much calculation can be avoided. But second part of the question is there. Systematic risk, unsystematic risk, we have to do risk analysis. And when we have to do risk analysis, in that situation, we need standard deviation, we need correlation. So for that purpose, I have calculated this number. So what is the learning out of this discussion? In the exam, if they just ask you characteristic line, if they ask you only that, then with this column total only, you finish up the matter. You don't require to show standard deviation, not required. The column total, just now I showed you, you finish up the matter with that. But in the problem, if they ask you systematic risk, unsystematic risk, if they ask you risk analysis, in that situation, you have to calculate like this. I hope you understood what needs to be done in which situation. Okay, let's go for risk analysis. Risk analysis of security. More than formula, I give you chart method like the way we discussed. So risk analysis, we are going to write as total risk of a security. Total risk of security. That is going to be sigma s square. That is how much? 9.104 is it? 9.104 square. Why square? Basics you remember? Standard deviation is used for expression of risk. Variance is used for simplifications, calculations, analysis. Here we are doing analysis. So I cannot use standard deviation. I have to convert it to an area which is variance. So 9.104 square. 82.88. Okay. This is total risk of a security. This will be divided into two parts. Systematic risk. Unsystematic risk. What is systematic risk? It is the movement of the security connected with market. When the market change, you also change the movement of the security, the changes in the security in connection with the market. So, if I have market variance, can I calculate security variance? That is formula given by sigma m square multiplied by beta of security square. Logic I told you, or one thumb rule I told you. If you start from market and you have to come to security, from the market to come to security, the thumb rule is you multiplied by beta. Remember this like a thumb rule concept. So we have market variance sigma m square and we multiplied by beta to come to security. Why are you doing square? I am analyzing. Analysis will happen only with variance. So standard deviation I should square. That becomes variance. And when I do this square, the coefficient also will be squared. So beta will be squared. Systematic risk. What is market variance? Sigma m square. 6.34. 6.34 square into beta square. I think 1.2 we calculated. 1.2 square. And one more thing, in some problem in the question, they only will give you systematic, they will only give you variance, market variance. That you don't square it. Market variance means it is already squared, but beta coefficient should be squared. So if they give you standard deviation, that you square. to get variance. If they give you variance, don't square that. Very silly, but some people do that mistake as well. So that is what is your systematic risk. 6.34 into 6.34 into 1.2 into 1.2. 57.88. This is systematic risk of security. Unsystematic risk, the movement of the security not connected with the markets. Movement of the security for other reasons than market, specific reasons, micro factors, management, employee problem, labor problem, or interest rate or leverage position of the company, capital structure, fundamentals, what is specific to the company. That is unsystematic risk, calculated as a residual number, that is total risk, sigma s square minus systematic risk, that is sigma m square into beta square. Don't be offended by the formula, it is a balancing figure. So total risk is 82.88 minus systematic risk is 57.88. So balancing figure 82.88 minus 57.88, that is 25. And we mention the symbol as sigma E, standard deviation of E, that is E for error or deviation, residual, different names. Systematic risk of security is residual. And we have one more formula for it. Instead of using the market variance, I can use the security variance and try to see to what I am connected with the market, from security to the market. That I can do with the help of correlation coefficient of determination. That is sigma s square into r square, coefficient of determination. And this one can be calculated as sigma square into 1 minus r square, coefficient of non-determination. Again, what is the logic behind this? What is coefficient determination? If you remember the basics, I told you this represents the accuracy level. Like if r square happens to be 0.8, that means my estimations regression line is an estimated line. Actual points may be above, actual points may be below. Regression line is an estimated line. Regression concept is an estimation. And what is our accuracy or estimation? That is given by coefficient of determination. So I have market variance. And what is my accuracy? That much I will multiply. For example, in this case, return of security is 82.88. And what is R we calculated? 0.8359, please square it. 0.8359 square it. How much you get? 0.8359 square. 0.6987, around, let's say 69.87 percentage. My accuracy is 69.87. So out of 88.88 security variance, 69.87 I can predict using the market. I can predict using market, which means this is what is depending on market, connected with market, estimated using market. That is what is systematic risk. Let's see if we get approximately same answer. 82.88 into 0.8359 into 0.8359. 57.7. You get small difference. That is because of mathematical round off you have done. For that reason, the difference because of mathematical round off. That's fine. This is balancing figure you can do, or 1 minus r square. 82.88 into 1 minus 0.8359. 0.8359 square. So 0.8359 square you do minus 1 into 82.88. You get 24.969, let's say 24.97. I told you, small difference, that's because of rounding off. But one small thing, be very clear. When I use market variance, when I start from the market, I will use beta. From the market to security, I will use beta. But I'm using security variance. Then I'm going to multiply it by R square as a alternate formula. But I would recommend the first method from exam point of view as well. More than using R square coefficient determination, the practice of using beta is more relevant, reliable from exam point of view, because this concept I told you from market to security, I'll be using it in many other places as well. So that concept, I hope, is very strong in your mind, going to be strong in your mind. So that easy to apply. But when I use determination, coefficient determination, I have to use security variance. You have to change your mind a little bit. And this may not be given in the problem also in all questions. So I would recommend the first method, using beta method from exam point of view. So what is the summary of this problem? Characteristic line is same as regression line. The column required are security, market, S minus S bar whole square, M minus M bar whole square, S minus S bar into M minus M bar. Standardization, correlation, correlation, regression line, B, A, alpha, beta. But if they ask you only characteristic line, this measures I don't have to do. Beta formula directly I can do. Summation S minus S bar into M minus M bar divided by summation M minus M bar whole square. The covariance and market variance, only using those two, I can arrive at beta. But if they have asked you to do analysis of risk like this, then I need standard deviations, I need correlations, I need beta. I hope this should give a complete picture with respect to the characteristic line and systematic risk and systematic risk. Good. Okay. So hope you got the next question. This will be based on Sharpe index portfolio risk, moving away from the Markowitz. A has the portfolio having the following features: security, LMNK, beta, random error, weights. You require to find the risk of the portfolio if the standard deviation of the market index is 18%. Now, risk of the portfolio, they said. Am I going to use Markowitz here? The answer is definitely no, because Markowitz, we usually write 2 security, maximum 3 security. More than that, it becomes a big formula. A plus B plus C whole square, A square, B square, C square, 2AB, 2BC, 2CD. That becomes a long list. Or when they've used the word like random error, weights, random error, beta, it means they are trying to ask only the uh, Sharpe index. Okay, remember how do we calculate the Sharpe index concept? Formula, you don't worry. I will try to explain with the help of pure concepts. Just 1 second. Let me just take this part. Okay. So let's solve it logically, structurally. So Sharpe index. How are we going to calculate the Sharpe index? Portfolio risk using Sharpe index. Portfolio risk using Sharpe index. So we will have 2 aspects. Hope you remember this chart we discussed in the basics. I'm going to write systematic risk of portfolio and unsystematic risk of portfolio. In systematic risk, how do we calculate? Do you remember? From the market, if I want to compute security, what should I multiply? From the market risk, if I want to come to the security risk, what should be multiplied? What is the parameter which connects the both? We have discussed in basics. To move from market to security, it is beta. In fact, beta square, because we will be using variance. Similarly, from the market to come to the portfolio systematic risk, we have to multiply by beta of portfolio. That is, market risk means sigma m square multiplied by beta of portfolio. This will give me the systematic risk of portfolio. And similarly, I am going to calculate unsystematic risk. How do we calculate unsystematic risk? Of each individual security multiplied by weights. Ultimately, it's a weighted average. In the sense, it's going to be like this: sigma E 1 square for security multiplied by weight in 1. We have 4 security here. Hope you understand the logic. Unsystematic variance multiplied by weights, weight square. Similarly, second security, unsystematic variance E2, E for error. That's what they say, unsystematic square multiplied by W2 square plus sigma E3 square multiplied by W3 square plus E4 square multiplied by W4 square, E4 square, W4 square. Even E2, E3, E4 are just the symbols. Don't worry much. Basically, unsystematic risk of particular security multiplied by their weights. And do the total, you get the overall risk. Okay, first of all, you need beta of portfolio. That is very simple. It's going to be a weighted average. How do you calculate the weighted average? Beta is there multiplied by weight. Okay, that's column alignment. I have to change slightly. Just give me 1 second. Okay, so beta we have, weights we have. So 1.6 into 0.25. 1.6 into 0.25. 1.15 into 0.3. 1.4 into 0.25. 1 into point. Please tell me, what's the portfolio beta coming to? Weights multiplied by beta, nothing else. Weights multiplied by beta, respective weights, respective beta. $1.295. Okay, I hope you are getting that. 1.295. Portfolio beta is 1.295. Okay, then what we are going to do, systematic risk. Market variance multiplied by beta square. Market variance is 18%, market risk. So 18 square. Be very careful about this calculation, because some people, sometimes in the exam, they'll give you variance itself. They'll tell you market variance is 18. When they tell you market variance 18, don't do 18 square, because variance itself means square is already done. Keep it in mind. Very, very important point. Many people do wrong in this case. If they give you variance, square is already done, don't square again. This is standard deviation, so we need to square it. Multiplied by beta 1295, we will square it. So you get 18 into 18 into 1.295 into 1.295, 543.36. Okay, so this is systematic risk of portfolio. We need to calculate now unsystematic risk. So let me continue this process. This sigma E, nothing but the errors. You see random errors, nothing but unsystematic risk of the securities. So 71139. So 71139. These are all unsystematic risk. Square it. Multiplied by weights. Weight we know already. 0.25 square. 0.3 square. 0.25 square and 0.2 square. And do the total at the ends. You can use the calculator. Again, m plus MRC function. 7 square, 7 into 7 into 0.25 into 0.25 equal to m plus. 11 into 11 into 0.3 into 0.3 equal to m plus. 3 into 3 into 0.25 into 0.25 equal to m plus. 9 into 9 into 0.2 into 0.2 equal to m plus MRC. How much you get when you calculate? I think you get like first one, and if you want to show it calculation, it's like 3.06, 10.89. 3.06 plus 10.89 plus 0.56 plus 3.24. Approximately 17.75. 17.75. Okay. So 17.75 is the unsystematic risk. So systematic risk we got 543.36. Unsystematic risk we got 17.75. So total risk, if I add both, that is portfolio variance using Sharpe index, 543.36 plus 17.75, 561.11. Then if you want to calculate portfolio risk express in standard deviation, as I told you earlier, in the exam, let them ask portfolio variance, let them ask portfolio risk, let them ask portfolio standard deviation, let them ask whatever they want. We will calculate both. Variance we calculated, take a square root of this, you get 23.69. Ultimately, this is the risk of the portfolio using Sharpe index. Okay, so hope you have done till here. Please observe, we are not by hearting any formula. We are writing in a very logical, structural manner. So it's very important you also practice this way so that you don't have to by heart any formula. Some places we have to do, but we are, even though we are not doing derivation of any formula, logical elements in the formula we are trying to interpret and then use it accordingly. Because many times what happens in exam or among students, my observation is you know all the formulas, but you don't know which formula to apply in that problem, because sometimes in the problem they will not tell you use this formula. Lot of formula will come to your mind, and if you have learned little bit of logic at least, rather than scolding their family of the person who has invented, you'll be able to appreciate better, you'll be able to remember better. Okay, so that's it with respect to this problem. Okay, so hope you got this one. Following are the details of portfolio consisting of 3 shares, XYZ, portfolio weight, beta, expected return, portfolio variance. Standard deviation of the market portfolio return is 12%. You are required to calculate the following: portfolio beta, residual variance of each of the 3 shares, portfolio variance using Sharpe index model. Okay, the question is very, very clear. We have to calculate using Sharpe index model. And one new term we have using residual variance. Any idea, my dear friends? What do you understand by residual variance? Okay, nothing different. Residual variance just means unsystematic risk. You know how do we calculate unsystematic risk? We take the total risk of the security, we subtract systematic risk. The balance comes to unsystematic risk. So it's a balancing figure, right? So it's computed as a remaining amount, as a balance. So it's called as residual variance. Residue, what remains from the total risk, we understand how much is attributable to market, which we call it as systematic risk. Remaining balancing figure is unsystematic risk, and that's why that's called as residual variance. So residual variance is nothing but unsystematic risk. Okay, one thing you observe, they have given total variance. They have given total variance. Total variance means this is already after squaring it. This is already after squaring it. So you should not do square again. This itself is variance, sigma square. So please don't do the square of this number when you're calculating something. And one more mathematical part, keep it in mind. This percentage and converting into decimals sometimes can give a conflicting answer. So what I would recommend is very simple. What is given in the question, follow the same route. Now in the question, they have given decimals, right? 0.02, 0.01, 0.12. When they give you the question decimals, you continue the answer also decimals. But in the question, if they give you 2%, 1%, 0.12%, something like that, then you also continue with uh, percentage. So simple approach, whatever is the units they have given in the question, follow the same thing in solution. Okay, so first thing is to calculate portfolio beta. We have beta here and we have weights. You know how to calculate the portfolio beta? Weights multiplied by respective beta. So zero point 0.5 into 0.3, 0.6 into 0.5, 1.2 into 0.2. So let us do it. Just give me 1 second. Okay. Actually, I can do later also. Just 1 second. Okay. I'll calculate it later because anyway, it is going to come when we prepare the chart. But anyway, if you want, you can calculate now itself. Uh, or we will follow the structural approach. Okay. What approach we are going to follow? Understand the process. Try to visualize first. Then we'll go further. Portfolio beta, easy to calculate. I discussed just with you now. Number will calculate later. That's not a problem. Residual variance of each of the shares. Again, you remember the chart process. Total risk of a security. We calculate systematic risk. Balancing figure becomes unsystematic risk. So we prepare chart 1 for X security, same chart for Y security, and same chart for Z security. So 3 charts we prepare. Total, systematic, and schematic. Total, systematic, and schematic. Total, systematic, and schematic. Then we are going to mix all of them. That becomes portfolio. That's what they're asking last. Portfolio variance using sharp index model. Let's calculate. First, we'll calculate for individual stock for security X. So I'll show you how to calculate for X. Maybe you can try later. You can try after this for Y and Z. Let me explain X. What is total risk? They only have given variance. Please observe. So don't square this. They have given variance 0.02. They have given decimals. I will continue with decimals. And this is variance. So I don't have to square it. This itself is after squaring it. So total variance 0.02. I will divide this into systematic and schematic. Systematic means market variance multiplied by beta of this security. Market variance, they said 12%, so 0.12 square. That I am going to do square. Why? Because that is standard deviation. The standard deviation I have to square it. Therefore, it is going to be market variance 0.12. They said 12%, 0.12 and square it. Just give me 1 second. Just give me 1 second. I'll just do a little bit of adjustments. Okay, fine. Okay, so 0.02, we are divide this into systematic and schematic. Market variance multiplied by beta square. Balancing figure and systematic, which is what we called as residual variance. Now beta of the beta of security X 0.5, square it. Market variance, they say 12%, but we are doing in decimals, so 0.12 square. So calculate 0.12 into 0.12 into 0.5 into 0.5, you get 0.0036. So what is balancing figure? Unsystematic risk 0.02 minus 0.0036, that comes to 0.0164. So this is for security X. Similarly, same process you do for security Y and you for security Z. I will give you 2 minutes. You please try. Then we'll do portfolio together. Okay, so let's see if you are able to do for security Y. If you have done, check it. Systematic and systematic, beta into market variance, 0.12 square into zero point 0.6 square, and balancing figure 0.00482. So unsystematic risk for security X is 0.0164. For unsystematic risk similarly 0.0482. For Z, if you have done, please check it out. It is 0.0992. 4 decimals you can take it because too much decimals are there. I'm taking few more, but in exam you can take 4 decimals. Please check it out and see if you're able to get this one. Are you getting 0.05184? Is it so? Let me calculate. 0.12 into 0.12 into 0.6 into 0.6. Isn't that it is 0.00? Oh, 5184. Not 5184, is it? Okay. But is the balancing figure correct? Or that is right? Or that is wrong? Point 0.0048. I think balancing figure is right, correct? Only this typing mistake, that's all I think. Balancing figure is right. Okay. So I think I just correct it. It's 5184. Okay. I think now it's fine. Once you're comfortable in the exam, you don't have to follow this chart. You can write it in 3 lines also. Very simple. Market variance into beta of security X minus uh, the risk security X variance minus this. This will give you for security X and systematic variance. Y for Z. So you don't have to write the chart like this in exam. You can write in one line only. But till you get that confidence, till you do that practice, you follow the chart approach. I hope you have got it till here. Now let's do portfolio. You know what is portfolio to be done. Systematic risk of the portfolio, we should calculate. Unsystematic risk of the portfolio, we should calculate. We'll do the total, and that's how we'll arrive at the portfolio risk using Sharpe index. Same approach. Portfolio risk, systematic. What we did in security, market variance, we multiplied by beta of security. Here what we are going to do, market variance, we multiplied by beta of portfolio. So market variance is, we know, that is same 0.12 square, market variance 0.12 square, multiplied by portfolio beta. Portfolio beta, we have to multiply with the weights. Weights they have given, and beta we know, beta 0.5, 0.6 and 1.2 multiplied by 0.3, 0.5, 0.2. So the weights multiplied by beta. So 0.3 into 0.5, W1 beta 1, 0.5 into 0.6, W2 into beta 2, 0.2 into 1.2, W3 into beta 3. So this will give us the portfolio beta multiplied by market variance. I think portfolio beta comes to 0.69, market variance 0.12. So square both of them. That will give us the systematic risk of portfolio. So you please calculate the systematic risk of portfolio. Then I'll come to the unsystematic risk. Okay. Hope systematic risk is done. Let me come to unsystematic risk. Unsystematic risk, what we are going to do? We do a weighted average. We take the X unsystematic risk, we take the Y unsystematic risk, we take the Z unsystematic risk. Then we mix all of them by multiplying by their weights. Since these are all variances, the weights will be multiplied by weights square. This is itself is a variance. So 0.0164 when you take, don't do square of this. This itself is a square. But in the some problems, what they would have done in the exam, they would have given random error as standard deviation. So from standard deviation to come to variance, we have to square it. But this is itself is square. This itself is systematic variance. So no need to multiply it by square. So we take 0.0164 multiplied by its weight square. 0.0164 is variance multiplied by weight. Weight is 0.3 square. Then 0.00482 is the unsystematic variance of second multiplied by its weight square. 0.5 square. Then third security 0.009264 multiplied by its weight square into 0.2 square. So since these are all variances, don't square it. In the question had they given in some problems like random error, standard deviation, then we square that. But these are all already variance, so don't square it, but their coefficients, weights must be squared. So write down, simplify. I think if you use M plus MRC correctly, you get 0.00652. That is systematic variance, and if I do the total, that will give you total risk using Sharpe index. So write down and let me know if you have any doubts. These are all repeatedly asked questions in the exams, whichever problem we are doing now. So make sure that you understand the calculation process clearly. Even if you don't know what is Sharpe index, what is Markowitz theory, you don't know, completely fine. But from exam point of view, you should know this formula, this approach. Rather than formula approach, we are following a chart approach. I hope this is more convincing. Okay, what we got is variance. If I take a square root of this, I can also do standard deviation. As I told you in the exam, always calculate both. We don't know what the examiner will expect. So this was systematic risk. This was unsystematic risk of portfolio. Together, we got the total risk 0.0135. If I take a square root of this, you get standard deviation. Okay, I hope it is done. I'll go further. Next. Hope you got this question. This is exam question, November 2018, old syllabus. Mr. Gupta is considering the investment in the shares of R Limited. He has the following expectations of the return on the stock of the market. Probability R Limited return, a market return. They only have given the returns. You are required to calculate the expected return and the variance and the standard deviation for R Limited. Calculate the expected return, variance and standard deviation for the market. Find out the beta coefficient for R Limited shares. So I need standard deviation and I need beta. Okay, for expected return, what are the columns required? I'll try to fit everything in one column. The security return, I'll call it as S. And probability is P. And expected return means S into P. For variance, for standard deviation, what do I require? S minus S bar. S minus S bar whole square and then S minus S bar whole square multiplied by P. This is for security S. The same column I repeat for market, market, probability same column, market into P, M into P, M minus M bar whole square, then M minus M bar whole square into probability, and I need covariance because I need beta, M minus M bar into S minus S bar into probability. So what are the columns I'm going to write down? These are the ones. Okay, let's write the columns. Probability first you write down. S column they have given. M column they have given. First you repeat what is given. Then we'll go further. I'm trying to fit everything in one table. You can prepare multiple table also. Okay. Hope you've written. What we require now? M into P or S into P. For security return, expected return 0.35 into 30, 10.5, 0.3 into 25, 7.5, 0.15 into 40, 6, 0.2 into 20, 4. That is what is expected return. S bar, expected return of security, expected return S bar, both are same. We'll do same thing for M into P. 25 into 0.35, 8.75. 20 into zero point 0.3, that is 6. 30 into 0.15, 4.5. 10 into 0.2, that is 2. Total M bar, that is expected return from the market. Okay, then S minus X bar, 30 minus 28, that is 2. 25 minus 28 minus 3, 40 minus 28, that is 12. 20 minus 28, and that is 2. Sorry, minus 8. S minus S bar whole square, that is a 2 square 4, 3 square 9, 12 square 144, 8 square 64. S minus S bar whole square multiplied by probability. So this column S minus S bar whole square column multiplied by probability column. 4 into 0.35, 1.4, 9 into 0.3, 2.7, 144 into 0.15, 21.6, 64 into 0.2, 12.8, total 38.5. It is numeric, it is monotonous, but clerical, can't tell. You have to do. At least as compared to derivative chapter, forex chapter, here you know what to do once you know the formula clearly. It's just a manual process. Okay, this is what is actually variance of security. Which is S bar. S bar is 28. Don't divide by 4. When probability is there, you don't divide by n because total of probability is 1. This itself is S bar when probability is there. Don't divide by 4. We have multiplied. We have taken like a weighted average, proportionate weighted average. These two column total itself will give you S bar. And even for variance, standard deviation of security variance, don't divide by 4. This itself is variance of security S. Summation P into S minus S bar, don't divide by 4. When probability is there, don't divide by N. because this is not number of security, this is the number of chances, probability. Okay, this is what I've done for security, S minus S bar, S minus S bar whole square, P into S minus S bar whole square. Can you repeat the same three columns for market? So I'll give you time, you do it. M minus M bar, M minus M bar whole square, then M minus M bar whole square multiplied by P. So please prepare these three columns. Okay, I hope you have done. Let's see if you have done it. M minus M bar, that is 25 minus 21.25, 3.75, 20 minus 21.25 minus 1.25 and so on. M minus M bar whole square, then whole square multiplied by probability. Total, I hope you are getting 42.188. Okay, I need covariance, that means M minus M bar into S minus S bar into probability, that is S minus S bar is this column, M minus M bar is this column, hope you calculated, if not copy down quickly, multiplied by probability, these three should be multiplied. So 0.35 into 2 into 3.75, I think 2.625, 0.3 into minus 3 into minus 0.125, minus of minus plus 1.125, 0.15 into 12 into 8.75, 15.75, 0.2 into minus 8 into minus 11.25, minus into minus plus 18, total 37.5. Then standard deviation of security, that is square root of S minus S bar whole square into P. No need to divide by N. When probability is there, no need to divide by N. Probability will take care of it. That is this column directly. This is its variance actually. Variance is 38.5. Square root of it, you get standard deviation. Similarly, market, M minus M bar whole square into P, that is 42.188. Here we got that itself is variance. No need to divide by N. Divide a square root, you get standard deviation. Then we don't have to do correlation coefficient. For I can do directly beta calculation. Covariance divided by summation M square. Covariance itself is this. Why? Because covariance is summation x minus s bar, I mean here s minus s bar into m minus m bar into p. Divide by n not required. That itself is 37.5. And market variance is summation m minus m bar whole square into P. No need to divide by N. That itself is, we have that column total 42.188. Covariance by market variance 37.5 by 42.188. We get 0.888, 0.89. Beta less than 1, which means security is less riskier than market. So if the probability is given, then you have to adopt this approach. Okay, so hope you are able to do a typical problem asked in the exam many times. So very possible you might do clerical errors. Practice is the only solution. Okay, so this is regarding the beta calculation of using just the X return, Y return, when returns are security return of market, and along with probability as well. Okay, good. Okay, so sorry. Now let's do problem on CAPM. Come to this problem. An investor is seeking the price to pay for a security whose standard deviation is 3%. The correlation coefficient for the security with the market is 0.8. The market standard deviation is 2.2%. Return from the government security is 5.2%, and from the market portfolio 9.8%. The investor knows that by calculating the required return, he can determine the price to pay for the security. What is the required return on the security? Okay, so what and all they have given? Security whose standard deviation is 3%. So this is standard deviation of security is 3%. The correlation coefficient for the security with the market, not with other security, is 0.8. So R, correlation coefficient means R, 0.8. And the market standard deviation is 2.2%. Market standard deviation means it is going to be sigma M, which is 2.2%. Return from government securities, which will take it as RF, 5.2. And return from the market portfolio, which means RM, is 9.8. The investor knows by calculating the required rate of return, he can determine the price to pay for the security. So he can do valuation, but he wants to know the required rate of return. What is the required rate of return of the security? So required rate of return of security for a given level of risk. That is what is called as the return as per CAPM. The return as per CAPM. So we can say cost of equity, which is RF plus RM minus RF multiplied by beta. Beta is not given in the problem, so we'll have to make use of it. So typically for beta calculation, remember three formulas. One R into standard deviation of security by standard deviation of market. One sigma The other one, market variance by covariance by market variance. Another, the formula, the S minus S bar into M minus M bar into P by M minus M bar into P. That formula also you can remember. But typically two formulas you have to remember, and for full calculating the beta from the full-fledged problems, you can use that formula. N into summation Sm minus summation S into summation M divided by N into summation M square minus summation M the whole square. And one thing I forgot to tell a shortcut, overall, not a shortcut, small hint. Always market comes in denominator. Always market comes in denominator. Look at any formula I've given you for beta. R into sigma S by sigma M, market denominator. Covariance by market variance, market is in denominator. Summation S minus S bar into M minus M bar by summation M minus M bar, that is also market denominator. Summation Sm minus summation S into summation M by N into summation M square minus summation M whole square, market is denominator. So all the formulas, M comes in denominator. That shortcut you remember, that will help you a lot. Okay, so let's calculate here, because correlation coefficient is given. Beta is R into sigma S by sigma M. Correlation coefficient given, which is 0.8. Standard deviation of security given 3%. Standard deviation of market also given 2.2%, which is going to be 0.8 into 3 divided by 2.2. How much that comes to? 0.8 into 3 by 2.2. $1.09. Okay. 1.09. So let's compute the cost of equity now using this formula. Required rate of return, RF risk-free rate 5.2 plus RM minus RF, that is 9.8 minus 5.2 into 1.09. So 5.2 plus 5.01, that is 10.21. 1.09. Okay. 1.09. And please don't do calculate directly in calculator. There is a bracket here. Don't do 5.2 plus 9.8 minus 5.2. If you do 5.2 plus 9.8 minus 5.2, 5.2, 5.2 plus minus will get cancelled. So don't do like that in calculator. I see lot of students losing marks in exam like this. 9.8 minus 5.2 into 1.09. Second part you calculate that. Then add to the first part. You get the overall correct answers. Okay, let's go further. Okay, so come to this problem. The following information is available in respect of security X. Equilibrium 15%, market return 15%. 7% treasury bond trading at $140. Covariance of market return and security return 225%. Coefficient of correlation 0.75. You are required to determine the standard deviation of the market return and security return. It's a slightly reverse calculation. They have given the equilibrium return, that is return of a security. Market return, that is RM. Covariance, that is given covariance. And coefficient correlation R is also available. So standard deviation of the market not available, security return also not available, which we need to calculate. More importantly, RF is also not available, risk-free return. So for that, information available is 7% treasury bonds trading at $140. Treasury bonds, therefore we take it as risk-free security. But how much is going to be RF? What do you think? How much is going to be RF? Do you think it is going to be 7%? It is not. 7% is coupon rate. Trading at $140. So if you think from an investor point of view, how much risk-free return he is expected to get? $140 he invests, 7% he gets. So $140 like 140 rupees. You have to understand. So you need to do RF equals coupon, what you get, divided by market price of the bond, which is 7%, assuming face value 7, divided face value 100, on that 7% means 7, divided by market price 140 into 100. So that will get you 0.05, or 5%. So risk-free return is 5%. So please be careful about calculation of this one. And what is this formula we have done? Simple formula, return on investment, coupon is income, investment is market price. This is what we used to call it as yield. Remember yield, current yield for the immediate next year. What income I get for next year and what investment I make. Coupon by market price, current yield. This was like dividend yield, dividend by market price. What income I get in the immediate next year by way of income from investment in bonds, in this case treasury bonds. So RF I got, and what they have given, equilibrium return. So which means let's write return of a security, RF plus RM minus RF into beta. Return of security is given as 15, risk free is 5, plus RM, return of market is also 15, minus risk free 5 into beta. Simplify. So 15 minus 10 equals to 10, 15 minus 5 equals to 10 beta. So 10 by 10 equal to beta, or beta equals to 1. In fact, even without this calculation also conceptually you can tell. How? Market return is also 15, security return is also 15. When both of you are getting same return, which means what? Which means your return is likely to be same as market return, which means your risk is same as market risk. So beta should be equal to 1. Only when beta equal to 1, security market both are equally riskier, so equal return they get. That concept also you can do. And beta formula is R into standard deviation of security by standard deviation of markets. Okay, they have not given both of them. but covariance of market return and security return, that is covariance of market return, covariance between market and security is given to be 225. So beta, how do we calculate? Let's calculate the beta by one more formula before this. Beta equals to covariance, because covariance available, that's why. Covariance by market variance. Beta equals to 1. Covariance is given to be 225. Market variance. So market variance equals 225 into 1 means 225. So if I take a square root, standard deviation of m equals to 15. Now use the other formula, beta r into standard deviation of security by standard deviation of market. Beta equal to 1, r is given how much? 0.75 into standard deviation of security by standard deviation of market. Standard deviation of market is 15. So if I cross multiply, 1 into 15 divided by 0.75 equals standard deviation of S. So standard deviation of S becomes 20%. In the material hint, I think it would have been printed as 11.25 or something. Please correct that. That is wrong. The correct answer is 20%. Correct answer is 20%. %10.22% hint. I don't know which problem you're looking at. Okay, let's go further. Okay, so come to this problem. Amal Limited has been maintaining growth rate of 12% in dividends. The company has paid dividend at 3 per share. The rate of return on the market portfolio is 15%, and the risk-free rate of return in the market has been observed as 10%. The beta of coefficient of the company's share is 1.2. You're required to calculate expected return of company's share as per CAPM and the equilibrium price share by dividend growth model. So Amal Limited has been maintaining the growth rate of 12% and the company has paid dividend of 3 per share. Company has just paid means we will take this as D0 and growth rate is 12%, that is G, and market return portfolio 15 RM. Risk-free return has been observed as 10% RF. Beta coefficient is 1.2, which is beta. So you are equal to calculate the expected return as per CAPM model. So return of security, cost of equity as per CAPM model is given by RF, which is 10 plus RM minus RF 15 minus 10 into beta 1.2. Five into 1.2 plus 10, 17.5. 6 plus 10, okay, 16%. And calculate the equilibrium price P0 as per dividend growth model, D0 into 1 plus G by KE minus G. D0 dividend just paid 3 per share into 1 plus growth rate 0.12 divided by cost of equity 0.16 minus growth rate minus 0.12. So 3 into 1.12 divided by 0.04. That will give you 84. That's the value per share, equilibrium price, value per share. Equilibrium is, yes, equilibrium price, fair value, fair price, intrinsic value, present value, theoretical value, all are same. Different names for the value, that's all, because price is market price. Apart from that, everything else is different values, different names. Okay, just give me 1 minute. System takes some time. Can you give us the formula sheets? You have to make it. When I've given you the theory, everything is given in the thing. And if I give you formula sheet, how will you know which one to apply? Just giving a sheet will not help you. You should know when to apply which formula. And that will come only when you prepare it. I think that's the least you can do. Everything I've compiled it for you. Only thing is you have to apply it. Okay. You got P0 as 90. How? I don't know which calculator. In my calculator, 3 into 1.12 divided by 0.04 is give me 84. Okay, let's go further. I hope if you wait for some more time, you get different answer in calculator. Okay, just 1 second. System is taking some time. I'm sorry, system is taking some time. It's not a mistake. Please bear with me. Okay. Okay, so let's move forward. Let's come to this problem. Again about beta application only. Come to this problem. Preeti, a school teacher, after retirement, has built up a portfolio of rupees 1,20,000, which is as to show, which is as to follow, which is as follows: stock, number of shares, market price, beta. Her portfolio consultant Sri Vijay has advised her to bring down the beta to 0.8. You require to compute present portfolio beta. How much risk-free investment should be brought in to reduce the beta to 0.8? Show the workings to prove that beta of 0.8 is achieved. Okay, so first we'll compute the portfolio beta, regular method. First we compute the weight, number of shares into market price will give you value. Value divided by the total, you get the weight, weight into beta, the product column give you the portfolio beta. Regular method, like the earlier problem. How much risk-free investment should be brought in to reduce the beta to 0.8? That means I think existing, let's say beta comes to 1.7. Now if you want to reduce the beta, the second point here telling risk-free investment should be brought in. Why is it so? Because risk-free investment will have beta of 0. Beta for risk-free investment is 0. Your existing portfolio, we don't know, we have to calculate. Let's say 1.7 beta. And if I add with risk-free investment which has beta of 0, when I merge both 1.7 and 0, this will come down. That's what they're asking. How much should be added such a way that it should reduce to 0.8. Two ways of interpretations possible. When I say how much risk-free investment should be brought in, that is the additional amount to be added, exist in addition to the existing one, or amount to be substituted. Both ways we can answer, and both ways answer is different. And normally, because they said investment should be brought in, we interpret amount to be added and not substituted. All those things I'll explain once more. Let's go to that one. So let's come to this. What is the present portfolio beta? Let's calculate that. Regular method, you know. Security, we have A, B, C, D, F, G, H, I, J, K, L, all those things. Number of shares given, market price given, multiply 1000 into 50, 50,000, 500 into 20, 10,000, 800 into 25, 20,000, 200 into 200, 40,000. Total 12 lakh. Then 5 lakh by 12 lakh, 0.4167, 10,000 by 12 lakh, 0.0833, 20,000 by 12 lakh, 0.1667, 40,000 by 12 lakh, 0.0333. Please write down till there. PPT visible, right? Okay, fine, good. Okay. Okay. So write down till there. Okay. Multiplied by beta. Beta given 0.9, 1, 1.5, 1.2. Multiply 0.9 into 0.4167, 0.375, 1 into 0.0833, 0.083. I'm taking 3 decimals. You can take 2, 4, no problem. 1.5 into 0.1667, 0.250, 1.2 into 0.333, 0.4. So total 1.108. So depending on which decimal you take, number will slightly vary, but that's completely accepted. So current portfolio beta is 1.108. Portfolio beta. This is first part of the question. Current portfolio beta. Okay. Second part of the question. What is the objective? Reduce the beta to 0.8. Reduce the portfolio beta to 0.8. So existing, you're having 1.108. You add risk-free investments, which is going to be 0 beta. The portfolio, revised portfolio beta, our target or revised or target portfolio beta is 0.8. These are the prices we are assuming definitely at the time of investment. Correct. Every decision here is made at the time of investment and expected return comes later. So all these things are as on dates at the time of investment. Cost only, investor's cost. Correct. Okay. Now, so how much should be the investment? This is the beta. What should be the weight? Now, the weight, let's say total weight is 1 and risk-free investment is what we want to understand, how much to be invested. Now amount wise, how do we put you can compute the percentages or you can compute the amount method also. Let's go for the weight method. The total of the weight is 1. Investment in risk-free security, let me say WF. And existing, I'll say 1 minus WF. So what is the portfolio beta is going to be? Weighted average, weight into multiplied by beta. Beta 1.108 multiplied by its weight 1 minus risk-free security plus this is 0 into this is we can ignore it, risk-free security 0 into WF should be equal to 0.8. Just simplify, you get the value of weight in security. Similarly, instead of putting the weights, you can directly compute the amounts also by putting the amounts there. Okay, anyway, let's write down here. What do we get? 1.8108 into 1 means 1.108 minus 1.108 into WF means 1.108 WF and 0.8 comes left side minus 0.8 equal to 0. This goes to right side. So 1.108 minus 0.8 means 0.308 equals 1.108 WF. So 0.308 by 1.108 is WF. So what is investment in risk-free security should be WF. Investment in risk-free security 0.308 divided by 1.108. Basically difference between these two divided by the existing one. .308 divided by 1.108. 0.2779 or 0.2780. 0.2780. So that is 27.87%. 27.80%. So when you structure your investment portfolio, 27.80, that is 27.80%, 27.79, but when you round off, 9 is there, 27997 is there. So we'll round off, you get 27.80. When you invest, when you make a portfolio, how much ever amount it may be, Does not matter. 27.80% you invest in risk-free security. Balance you invest in market, whatever other existing the security, risky security. That should be your combination. If that is the combination of the weights like this 27 point plus and whatever remaining 77 plus, that will give you portfolio beta of 0.8. Please write down in sentences. Write down sentences. When the portfolio consists of, when the portfolio consists of 27.8% in risk-free securities, when the portfolio consists of 27.8% in risk-free securities and balance in risky securities. And balance in risky securities. How much the balance comes to? Remaining 1 minus 0.2780, that is 72.20, is it? Balance in risky security 72.20%. Portfolio beta will be 0.8. Portfolio beta will be 0.8. Portfolio beta will be 0.8. Now they're asking only the weights, is it? What is the requirement in the question? How much means you have to calculate the amount. For that purpose, we know in risky securities what is the existing amount. Now here there are two interpretations possible. One interpretation, the existing amount will remain same and additional amount I am bringing in. That is one interpretation possible. Other interpretation possible, my existing amount I will not change. I am going to replace risky security with risk-free security. Both interpretations are possible. In this problem, which one to interpret, I'll come to that. But in some other problem, it might be slightly different. Are you able to get the point? There are two ways of interpretation. One, existing portfolio remains same, additional amount I will bring in. Another, existing amount is going to be my total amount. I am not going to bring anything new. Existing risky securities I will sell and other one I will substitute. Introduction versus substitution. Two methods are possible. In this problem, how much risk-free investment should he bought in? So additional amount is what our interpretation, but other interpretation also possible. So if amount in risk-free security is in addition to existing, this is one interpretation possible. Second, if amount in risk-free security is substituted in existing. So one is in addition and one is in substituted to existing. Substituted means what? Existing risky securities are sold proportionately. Risk-free securities are sold proportionately. Now, why existing should be sold? Because you're substituting. If something is purchased, something should be sold in case of substitution. Why proportionately? Only then weights will remain same. If you sell only one of them, the weights will change. So that is the second interpretation. Okay, now first interpretation. If existing amount is there, additional amount risk free is there, so what we are going to do, the amount of portfolio what we have, what is amount of portfolio what we have, total amount of portfolio 12 lakh, right? 1,20,000. 1,20,000. 1,20,000 we are going to write it in the existing risky securities column. Here we write 1,20,000 and risk-free security will come additionally and total portfolio will be this plus this. But if second interpretation you do, that is if amount in risk-free security is going to substitute, then total amount will not change. Total amount is going to be 1,20,000. Now, how do we calculate the remaining amount? Just the cross multiplication method, because total should be 100%. Now, just a cross multiplication you can do 1,20,000 72.2. How much for 27.8? Cross multiply. 1,20,000 into 27.8 divided by 72.2. We get 46,205. Okay. And total amount of portfolio will become 1,46,205. 1,66,000. Okay. 1,66,000. And if it is risk-free security, what you are going to do? Cross multiplication method. 1,20,000 is 100. How much for 27.8? Cross multiplication. Just divide in the ratio 27:72. 1,20,000 into 27.8 divided by 100. $33,360. And remaining in risk-free securities 86,640. And this one means existing is 1,20,000. It has to become 86,640. So remaining should be sold. And that is what is 33,360 should be sold and will be used for purchasing the amount in risk-free securities. Which stock to be sold? All stocks should be sold in proportionate manner. Then only weights will remain same. So that's why the second one is very rare interpretation. Unless asked, we don't do it. So the first one is always recommended. This is recommended. Recommended one. One more shortcut is there. You can use it for verification. Direct answer shortcut. Amount in risk-free security is going to be calculated by current beta minus target beta divided by current beta into existing portfolio amount. Current beta is 1.108. Target beta is 0.8. Divide by current beta, divide by 1.108 into portfolio amount, which is 1,20,000. So how much you get? $33,360. That's what this number is. This number you get Instead of dividing by current beta, you divide by target beta itself. That is another one, 1.108 minus 0.8 divided by target beta itself, you divide. That is 0.8 into 1,20,000. How much you get? 1.108 minus 0.8 divided by 0.8 into 1,20,000. You get 46,200, right? And this is what? This number here in the first interpretation. You divide by current beta, you get the second interpretation answer. You divide by target beta, you get the first interpretation answer. So you can use it for verification. Answer also you can get directly, but I don't know whether the examiner will accept this answer, because this institute has not given any solution. I have not seen any textbook. Just through observation I got this one, so I am sharing it with you. So don't use it for presenting your answer. You can use this for a verification purpose. And one more way of reducing beta is also there. That's called as shorting the security in derivatives, future market. That we discuss when we go to derivative market. But in the exam they can ask you same thing in one problem also. How to reduce it using risk-free security, how to use it, how to reduce it using Nifty futures, shorting in Nifty futures. But the shorting in Nifty future is part of derivative chapter. So we will do separately. But in exam they can ask both in one problem. Just be aware of it. They also asked us to verify. You can verify that later for your reference. Maybe we'll do it quickly, but one more interpretation I would like to do here. I hope you have taken down till here. Okay, now here they said how much should risk-free investment should be brought in to reduce it to 0.8. Similarly, in the question they can say increase the beta also possible. Just like you can reduce the risk, you can increase the risk also. Increase it to, let's say, 1.2. Now in this problem if they ask 1.2, you have to increase it. Let's not recalculate everything. Let's use the shortcut what I told you. For the first one I will say that. Let's say. So what is the shortcut? Amount in risk free. The shortcut I'm using, that is current minus target by target. Current minus target by target into whatever the portfolio amount. If you want to increase the beta to 1.8, current is 1.108, target is 1.2, divided by target is 1.2 into portfolio amount 1,20,000. So how much you get? $1.108 minus 1.2 divided by 1.2 into 1,20,000. You get some 9,200, right? Minus. Yeah, minus. This is for the first one. Now, how do you interpret this minus? Number, amount not important. I was talking about this negative sign. Negative will come. How do you interpret this negative interpretation? How do you understand this negative number? Positive number comes, amount of risk-free investment should be invested. What do you mean by negative? Amount that need to be borrowed. This represents amount of risk-free investment should be borrowed, amount of borrowings. So we need to borrow 9,200 and invest in all these securities proportionately. That's how my risk will reduce basically, or my existing investment I will withdraw, and to that extent I will borrow. Both interpretations possible. I did the first interpretation but for verification purpose, so don't worry about that. But importance is when you want to increase the risk. Remember, we have discussed in CML also, SML in capital market line also, capital allocation line also. When you want to get more return than market, you leverage your position. Your beta currently it is 1.108. You want to increase your beta, increase the risk. That is by not investing in risk-free security, borrowing risk-free security, and investing in risky security. Take the money from risk-free security where you pay interest and invest the amount in risky securities. You increase your risk. Okay, that's one more was possible. I just explained it to you. Show workings to prove beta is achieved. Is it there in the problem? To prove that? Okay, if they ask, let's do it. How will the financial risk be considered in that situation? Financial risk would have been already considered. That's how beta is increasing. Beta, we talk about levered beta, and levered beta means it's a combination of business risk as well as financial risk. Now, when we increase our beta because of borrowings, so financial risk is considered. Because of that only our risk is increasing. That is a concept which is being applied. How your risk is increased, how your beta is increased, you are borrowing. Your borrowing means you are creating a leverage, you are creating a financial risk. So beta is increased. So beta is increased due to leverage only. This 0.8 becoming 1.2 is because of financial risk. When we withdraw from the existing, will we invest the risky security to increase the beta to 1.2? As I told you, again, two interpretation possible. Existing amount one amount you borrow and additionally you invest. That is one interpretation possible. Or amount you borrow, existing amount you withdraw from your thing. So basically your equity will reduce and your debt will increase. That's one interpretation possible. Or existing equity remains same, your debt will increase and additional amount you borrow will be invested. Both interpretation possible, like the way I've explained. Both are possible. Amounts will be slightly different to maintain the ratio in that case. But my interpretation was, or my focus was in the negative part. Okay, they asked us to prove it. Okay, let's prove it. Let's take the first one. Let's not take all of the things. Let's take the first int one, 46 to 100. That one will do for verification purpose. So what is going to happen now? That's for the same list. You will have one additional thing, which is risk-free security. And this is going to be 46,205. So total market value 12 lakh 46. This was still 1 lakh 20. So 1 lakh 66. 205. Recalculate the weights. $50,000 divided by 1,66,205. 0.30808. 10,000 divided by 1,66,205. 0.0602. Uh, 0.0602. 20,000 by 1,66,205. 1.1203, 40,000 divided by 1,66,205, 0.2407, and 46,205 divided by 1,66,205, 0.2780. That's what we calculated already, 0.2780. Their respective betas, 0.91, 1.5, 1.2. Okay, let's calculate, multiply 0.3008 into 0.9, 0.27, 0.0602 into 1, same only 0.06, 0.1203 into 1.5, 0.18, 0.2407 into 1.2, 0.288, 0.29, and this will have 0 because you will have no beta for risk-free security, 0. So total 0.27 plus 0.06 plus 0.18 plus 0.29. So you got exactly 0.80. So target beta is achieved. Okay, again, let me tell you, beta is not a foolproof. This is historical data. It's just a measure, statistical measure. When you practically apply on a daily basis, the beta may not be hold good. These are all statistical indicators. Everything will not be 100% accurate. But when you make decisions, you make some basis applied. You can't do blind decisions. So beta is being applied in various cases, even in practical life. I have seen in many portfolio managers using this a lot. And this need to be reported also in mutual funds and all. These need to be reported also. Anyway, so this is what this problem is all about. Okay, let's go further.